This podcast is for informational and educational purposes only and should not be construed as investment, tax, or legal advice. Any examples or frameworks discussed are general in nature and may not be suitable for all investors. All investing involves risk, including the possible loss of principal. Past experiences and planning approaches do not guarantee future results. Picture this. Family builds meaningful wealth over decades. They make prudent decisions, they carefully manage their risk, and somewhere along the way, they purchase a variable annuity. And at the time, it feels like a smart move. They may have maximized their tax deferral in other vehicles, and they decide to use the variable annuity as a way to deal with income and contribution limits of IRAs and qualified retirement plans. And then for years, it just quietly grows in the background. No taxes, no urgency, no problem, until one day it becomes one. So in one case, this scenario became reality. This family had accumulated a large annuity purchased years ago under very different assumptions. And over time, the value grew as it rode the wave of U.S. stock market exposure. And on paper, looked like a total success. But beneath the surface, there was a hidden issue. There was a large embedded gain that had never been taxed. And unlike other investments that invest in the U.S. equity market, when that gain is eventually realized, it doesn't receive capital gains treatment. The annuity is taxed at ordinary income rates. And that distinction matters a lot more than most people realize. So in this scenario, at some point, a decision had to be made. Do you continue holding the annuity and defer the tax further? Do you begin withdrawing and create a trigger for potentially high income tax rates? Or do you just reposition the asset entirely and then accept the tax costs today? All those are pretty uncomfortable. And what once felt like a really wise, tax-efficient decision started to feel like a constraint. And it was pretty natural for the hesitation to be there because none of the options were palatable. So I see a few scenarios where this can crop up. Pre-liquidity planning, so annuities purchased before a business sale or a large income event. Legacy allocations, where there's simply older contracts held for decades without any review. And there's set it and forget it decisions, where assets are just never revisited as part of the broader financial picture and its evolution. And in each case, the same dynamic appears. Tax deferral creates flexibility early, but reduces flexibility later. The tax deferral is not inherently good or bad. It's a timing decision. And like any timing decision, it depends on what happens next. So in some cases, deferral works beautifully, but in others, it can create a concentration of future income that pushes distributions into higher tax brackets, limits control over timing, and can complicate estate planning for the next generation. This is especially important for families who are thinking beyond their own lifetime. Because when certain assets pass to heirs, the tax treatment doesn't always reset in a favorable way. And what looked like a tax advantage from the beginning can turn into a compressed tax obligation for the next generation. So if you zoom out, this really isn't about annuities. It's just the example I wanted to use, but it illustrates a broader principle. Any strategy that defers a liability long enough can eventually turn into a constraint. And we can see this across multiple areas of wealth: retirement accounts, concentrated stock positions, deferred compensation, real estate with large embedded gains. The specific vehicle changes, but the pattern doesn't. And even in the high net worth world, the focus remains the same: preserve flexibility and avoid concentrated future risks. So if you or your family do have a large annuity with a meaningful gain, it might be worth just taking a step back and asking, what's the long-term plan for this asset? When will this tax eventually be paid, and what rate do we think that's going to happen at? And does this still fit within our broader structure of wealth? By keeping it, are you preserving optionality or just gradually losing it? There's no right answer. Everyone's got a different situation, but I do think there is a right process. I've said this a lot before, but the most expensive financial decisions can be ones that don't feel all that risky. They're the ones that feel safe. And because of that, they go unquestioned for a really long time. And I picked on a variable annuity here, and it can be a useful tool in the right context. But like any tool, its impact depends on how and when it's used. And sometimes risk in a portfolio isn't just volatility. It's actually inertia.